Stop for a second, because what just happened in gold and silver is not a metal story. It's a system story. And the system just did something most people don't notice until it's too late. It forced everyone to reprice the future, not react, reprice. Growth expectations, inflation expectations, interest rate expectations, currency expectations, credit risk, corporate margins, consumer demand, the whole chain. And it happened fast because in a debt-heavy world, policy volatility doesn't land like a pebble. It lands like a hammer. Here's the claim, and I want you to treat it like a warning label. This jump wasn't an accident, it wasn't emotion, and it wasn't random. It was the predictable output of a repeating pattern, one that shows up every time a leveraged economy tries to solve internal stress by injecting friction into trade. If you're tempted to shrug and say, it's just another headline, listen carefully. A system loaded with leverage behaves like a pressurized tank. In a low-debt world, you can make policy changes and the economy absorbs them. In a high-debt world, the same changes propagate like shockwaves. What looks small on paper becomes a chain reaction in reality. So when you hear tariff uncertainty returns, don't hear it as politics, hear it as physics. Because tariff uncertainty is not just a trade variable, it's a rules variable. It's the market being told the framework is unstable again. And the moment rules become unstable, gold and silver stop behaving like commodities and start behaving like what they've always been in moments like this. Scoreboards for trust. This is where most people get trapped by the wrong story. They see gold rising and they say fear. They see silver jumping and they say speculation. But that's not what the market is doing. The market is pricing a probability shift, a distribution shift. The future is no longer one smooth path. It becomes a fan chart with fat tails, more outcomes, wider outcomes, uglier outcomes. And when the distribution widens, the rational move is not to make a heroic prediction. The rational move is to buy insurance. Gold is insurance against credibility problems. Silver is the same insurance with extra volatility because it lives in two worlds at once, monetary demand and industrial demand. In calm regimes, that's manageable. In unstable regimes, it becomes explosive. Now here's the part that should make you sit up. This isn't a one-day event. This is a staged transition. And the easiest way to prove that is to show you the machine that produces it. Because once you see the machine, you stop getting blindsided by surprises that weren't surprises at all. So here's what I'm going to do, and I want you to stay with me because the payoff is practical, not academic. I'm going to give you a 4-step pattern that repeats across history. Then I'm going to prove it with 3 case studies. Then I'm going to apply it to what's happening right now. Tariff uncertainty returning, metals jumping, markets repricing, until it becomes impossible to pretend this is random. And I'm going to keep making it personal, because engagement dies when people feel like they're listening to a lecture. So every time we confirm a step, I'm going to translate it into what it means for your costs, your planning, and your exposure. Here's the pattern. 4 steps, always the same order, always the same logic. First, the foundation. A system builds legitimacy. Trade is predictable enough that companies invest. Money is stable enough that people sign contracts. Rules feel consistent. The future feels calculable. Confidence grows. Credit expands. Second, overextension. The system starts making promises larger than its productive base can support. Debt rises. Leverage rises. Political commitments expand. Everyone gets comfortable because the foundation still looks stable. Businesses optimize for efficiency instead of resilience. Governments borrow because it's easier than reform. Markets price risk as if shocks are rare. Third, the trigger, the loss of control zone. A shock hits the plumbing. Often it's trade friction, tariffs, sanctions, supply chain fractures, shipping bottlenecks, energy shocks, anything that increases real-world costs and uncertainty. Policymakers respond under pressure. They patch one problem and create another. Confidence wobbles. Not because people are irrational, but because the framework is no longer predictable. Fourth, the repricing. Capital migrates from promises to proof, from paper claims to hard assets, from trust me to show me. This repricing is not polite, it's fast, because once belief cracks, everyone rushes to protect themselves before protection gets expensive. Gold and silver are classic recipients of that migration, not because they're magical, because they're outside the direct reach of policy. They're the market's way of saying, we don't trust the rules to stay stable. Now we prove it. First case study, the early 1930s, tariffs, collapsing trade, and the fracture of monetary arrangements. The foundation came after World War I, when the world tried to rebuild a functioning trade and financial order. Many countries aimed to stabilize currencies and restore confidence with gold-linked frameworks. The promise was simple: disciplined money, normalized trade, stability returns. Then came overextension. War debts and reparations hung over governments. Banking systems were fragile, economies were imbalanced. Political leaders tried to force a return to normal monetary discipline, even when the underlying economy couldn't support it. It looked stable on the surface. It was fragile underneath. Then the trigger hit the plumbing. In 1930, the United States passed the Smoot-Hawley Tariff Act, raising tariffs across thousands of imported goods. Retaliation followed, trade contracted, and trade contraction is not just less commerce, it's less revenue, more defaults, weaker banks, tighter credit, deeper contraction. A spiral because the shock hit the system's connective tissue. At that point, policymakers faced an impossible choice: defend the monetary promise at the cost of domestic pain or abandon the promise to relieve pressure. And democratic politics rarely tolerates the level of pain required to preserve rigid commitments in a downturn. So the repricing came, and then the regime shifted. Countries abandoned gold convertibility or adjusted pegs because maintaining them required brutal internal deflation, wage cuts, unemployment, austerity. The monetary order broke because it couldn't coexist with collapsing trade and unpayable obligations. Here's the mechanism you need to remember. In a fragile system, tariff escalation doesn't stay in the trade lane. It infects finance. It accelerates monetary regime shifts. The moment trade collapses, the monetary promise becomes harder to keep. Hold that thought. We'll use it again. Second case study, 1971 through the late 1970s. Bretton Woods breaks, supply shocks hit, and gold reprices credibility. The foundation was Bretton Woods, currencies pegged to the dollar and the dollar convertible into gold at a fixed rate. Trade expanded. Reconstruction and growth built confidence. The system appeared stable because the U.S. anchor seemed firm. Overextension crept in quietly. The U.S. ran persistent deficits. Dollars flowed abroad. Foreign governments accumulated dollar claims that, in theory, could be converted into U.S. gold. The math became uncomfortable. Too many claims, not enough comfort margin. That's the quiet truth of overextension. Promises look stable until too many people try to redeem them. Then the trigger arrived. In 1971, the U.S. closed the gold window. Convertibility ended. The anchor was removed by policy. Then the 1970s brought oil shocks that pushed up energy costs and triggered broad inflation pressures. Growth slowed while inflation rose. Stagflation. Policymakers were trapped. Tighten and risk recession, or ease and risk entrenching inflation and eroding confidence further. That's the loss of control zone. The system can't deliver both stability and comfort. It must choose. And whichever choice it makes, confidence takes a hit. Then came the repricing. Gold rose dramatically through the decade, not because gold caused inflation, but because gold became the alternative measuring stick when money was no longer anchored. The market was repricing credibility. It was repricing the fact that the system's core promise could be changed overnight. The lesson is brutal and simple. If the anchor can be removed by policy, money is a political instrument. And when money becomes political, markets demand insurance. Third case study, Rome, debasement, price distortion, and the flight into real goods. The foundation was a trusted coinage and a wide trading network. Commerce functioned because people believed the coin represented real value. Taxation and logistics worked because money had credibility. Overextension followed. Military spending rose, political instability rose, obligations grew beyond what taxation could sustain without backlash. The state leaned on a quieter tool, debasement. Coins were minted with less precious metal content while keeping nominal value. That's financing commitments by diluting the unit of account. Then, the trigger and loss of control. As debasement accelerated, prices rose. Merchants demanded more coins for the same goods. People hoarded higher quality money and spent the worse. Trust fractured because the currency stopped functioning as a reliable store of value. The state responded with controls and coercion, attempts to force outcomes that trust normally produces voluntarily. But coercion can't create credibility. It only signals desperation. Then the repricing. People moved into real goods, land, grain, durable commodities, because the currency was no longer reliable. Barter increased. Local exchange replaced wide trust. Economic cohesion weakened before political collapse became obvious. Same mechanism again. Once money becomes the solution to political overextension, the market exits money. Now put these case studies side by side and notice what matters. Different eras, different institutions, different technologies, same structure, foundation, overextension, shock and loss of control, repricing into harder forms of value. Now we bring it to the present moment. Right now, gold and silver jumping as tariff uncertainty returns. And I'm going to apply the same pattern step by step, but I'm going to do it like an audit. Cold, mechanical, no romance. First, the foundation. For decades, the global economy ran on the assumption that trade friction would generally decline, or at least remain predictable. Supply chains spread across borders. Companies built just-in-time systems optimized for low cost. Consumers got used to cheap goods. That helped keep inflation lower than it otherwise would have been. Lower inflation helped justify lower interest rates. Lower rates enabled more borrowing. That's the foundation. Globalization plus credibility plus credit expansion. Now second, overextension. Debt rose across governments, corporations, and households. Markets became addicted to liquidity. Business models became dependent on stable input costs and smooth shipping lanes. Governments became dependent on borrowing rather than structural reform. And the public became dependent on stable prices even as the system was built on leverage. In an overextended system, efficiency becomes fragility. No slack, no redundancy, no cushion. A small disruption doesn't get absorbed, it cascades. Now third, the trigger, the loss of control zone. Tariff uncertainty returns, and I need you to understand what uncertainty means in market terms, because this is the whole story. It doesn't mean we don't know what happens. Markets never know what happens. It means the range of possible outcomes just widened dramatically. Models break down, probabilities shift, hedging demand rises because the cost of being wrong becomes higher. Tariffs are not just taxes on imports. They are shocks to supply chains, shocks to corporate margins, shocks to inflation expectations, shocks to retaliation risk, shocks to global coordination. And when those shocks return in an economy already sensitive to inflation and rates, markets are forced to reprice fast. Here's the trap that turns tariffs into a systemic event. Tariffs can push prices up by raising input costs. If inflation rises, central banks feel pressure to tighten, or at least keep rates higher. But higher rates in a debt-heavy system increase stress on housing, on corporate refinancing, on government budgets. If growth slows because trade friction hits both supply and demand, policymakers feel pressure to stimulate. But stimulus can reignite inflation or weaken the currency. Either way, the system gets cornered. That's what loss of control really means. It means there is no clean choice anymore. Every choice costs something, and the cost is visible. Now fourth, the repricing. Gold and silver jump. And the key point is this. Metals are often early movers because they respond directly to probability shifts. They don't need an official recession announcement. They don't need earnings season. They don't need a committee to declare reality. Gold is the pure signal. It says, credibility risk is rising. Silver is the louder, messier signal. It says, credibility risk is rising, and industrial reality is tangled in the same uncertainty. That's why silver can look wild. It's not just fear. It's the market trying to price a metal that sits in two worlds at once during a regime shift. Now here's the part most people miss, and it's the difference between watching a chart and understanding a system. The market is not just repricing tariffs. It's repricing the political environment that produces tariffs. Tariffs don't appear in a vacuum. They surge when domestic stress rises, when voters are angry, when industries demand protection, when leaders need a lever that looks like action. Tariffs are politically attractive because they can be sold as strength while shifting blame outward. But markets don't care about the sales pitch. Markets care about the second-order effects. Tariffs create friction. Friction creates costs. Costs create inflation pressure. Inflation pressure collides with debt. Debt sensitivity collides with rate policy. Rate policy collides with growth. Growth collides with politics. And politics collides with the temptation to intervene even more. That's how systems spiral. Not because anyone planned a spiral, because constrained systems produce constrained choices. Now I want to make this personal, because this is where people either stay engaged or they drift. If you're watching gold and silver and thinking, I missed the move, you're thinking too small. The real question isn't whether you missed a trade. The real question is what this move is signaling about the next stage, because metals moving is often not the end of the story. It's the beginning. Metals react early when trust shifts, then credit markets adjust, then equities, then hiring, then wages, then everyday prices. Then the political narrative catches up, late, as always. So, what do you do with this information, practically, without turning your brain into a doom machine? First, you stop treating gold and silver as entertainment assets. You treat them as information instruments. When they jump on tariff uncertainty, the message is, the baseline is less stable. Second, you identify where you are short volatility without realizing it. Most people are. If your household budget depends on stable prices, you're short inflation volatility. If your job depends on consumer confidence, you're short recession risk. If your portfolio depends on low rates, you're short rate volatility. If your business depends on cheap imported inputs, you're short trade stability. You don't need to be ashamed of exposure. You need to be aware of it. Exposure you can name is exposure you can manage. Third, you stop thinking in binaries. This isn't collapse or no collapse. Most systems don't collapse overnight. They degrade, they wobble, they change regimes. A regime change can mean years of higher inflation variance, higher risk premiums, tighter credit, and more political intervention. That can feel like chaos even if the system continues functioning. Now I'm going to do something deliberately because it raises retention and it's actually useful. I'm going to open a loop and I'm going to close it. Here's the loop. If tariff uncertainty is back, what happens next? Hold that question for a moment, because to answer it, you need to understand what tariffs do to the internal plumbing of a debt-heavy system. Tariffs raise costs. Higher costs mean companies either absorb margin compression or pass costs to consumers. Margin compression reduces investment and hiring. Passing costs raises inflation. Either route increases stress. If inflation rises, central banks have less freedom to ease. If central banks stay tight, credit conditions stay restrictive, and growth gets pressured. If growth slows, political pressure rises. And rising political pressure increases the likelihood of more intervention, more volatility, and more instability. That's why tariff uncertainty isn't just a variable. It's a regime amplifier. It increases the probability of policy mistakes because it increases the number of conflicting goals policymakers must satisfy at once. Now close the loop. What happens next? Typically, you see escalating interventions and wider repricing. Companies adjust supply chains. That costs money and takes time. During the transition, efficiency falls and redundancy rises. Redundancy is safer but more expensive. More expensive shows up as higher prices or lower profits. Governments respond with subsidies, credits, industrial policy, selective protection. Those may shield certain sectors, but they shift costs onto budgets. Bigger budgets mean more borrowing, more issuance pressure, and more stress on credibility. Markets demand higher risk premiums. That shows up as volatility. And volatility changes behavior. It makes businesses hesitant. It makes consumers cautious. It makes investors demand compensation. And in that environment, gold and silver don't need to be right about some apocalypse. They simply need the system to remain cornered. Now I'm going to give you a rapid, cold confirmation sequence, the kind that makes people rewind because it feels like a verdict, a foundation built on trade stability, credibility, and debt-fueled growth. Overextension through leverage and dependence on low friction and predictable policy. A trigger, tariff uncertainty, that widens outcomes and forces repricing of inflation, growth, rates, and currency assumptions. A repricing response into monetary metals as insurance against credibility risk. That's the machine. Now let's kill 3 myths that lull people to sleep, because these myths are why people get blindsided. Myth 1. This time is different because our system is exceptional. Every system believes it's exceptional while it's still functioning. Exceptionalism is a story people tell themselves to ignore constraints, but constraints don't care about stories. Debt is constraint. Trade friction is constraint. Political volatility is constraint. When constraints tighten, outcomes narrow. Myth 2. Modern economics solve this. No. Modern economics can describe trade-offs, but it can't remove them. You can't tariff your way to cheaper goods. You can't subsidize your way to infinite stability. You can't promise comfort while denying the cost. You can only shift the cost, and the market prices the shift. Myth 3. Technology will save us. Technology can raise productivity over long periods. It does not instantly neutralize policy shocks. It does not instantly restore stable rules. It does not instantly replace credibility lost when policy becomes unpredictable. In regime shifts, technology helps some players. It does not erase systemic trade-offs. Now here's the practical takeaway, framed in a way you can use tomorrow morning. You don't need to predict the next tariff announcement. You need to recognize the stage of the pattern, because the stage tells you what risks are rising. In stable foundation periods, the system rewards leverage, efficiency, and optimism. In overextension, the system rewards those things until it suddenly punishes them. In the shock and loss of control zone, the system punishes fragility. It punishes business models dependent on one cheap input source. It punishes households living on thin margins. It punishes portfolios built on the assumption that volatility stays low. In repricing, the system rewards resilience, liquidity, and hedges against credibility risk. So ask yourself a question most people avoid. What is my life optimized for? Efficiency or resilience? Efficiency is beautiful in stable regimes. Resilience is survival in unstable ones. And I want to make this interactive because forcing interaction forces learning. Pick one area, your job, your business, your portfolio, your household budget, and name one assumption you've been making that depends on stable trade and stable inflation. Just one. Write it down. If you can't name it, that's the danger. Invisible assumptions are the ones that break you. Now I'm going to tighten the urgency, but I'm not going to sell you panic. I'm going to sell you clarity. Gold and silver jumping on tariff uncertainty is the system saying, we can't model the future as smoothly as before. That's the message. And when that message appears, the risk is not missing a rally. The risk is continuing to plan under an old baseline, while the baseline changes under your feet. That's how people lose purchasing power quietly. That's how people get trapped in refinancing cycles. That's how businesses fail after one more cost increase they didn't hedge. That's how families get squeezed while politicians argue about narratives. Now, the hidden structural truth behind the whole thing, and I want you to really hear it, trade policy is not separate from monetary policy anymore. In an integrated world, trade friction becomes monetary stress. Trade friction increases inflation risk. Inflation risk increases rates pressure. Rates pressure increases debt stress. Debt stress increases pressure on central banks to stabilize. Stabilization increases questions about credibility. And credibility questions bid up gold and silver. That's not ideology, that's feedback loops. And feedback loops are why these moves look sudden. The system can look fine until a variable crosses a threshold, then pricing shifts rapidly. That's what you're seeing. So let's end with the final warning, cleanly, without theatrics. The pattern is structural. Foundation leads to overextension. Overextension leads to loss of control under shock. Loss of control leads to repricing into harder forms of value. Tariff uncertainty is not a small news item inside this pattern. It is a shock amplifier because it attacks costs, expectations, and coordination at the same time. That's why markets are repricing fast. So here's the closing, and I'm going to make it actionable. Track regime signals, not headlines. When metals move on policy uncertainty, treat it as a stability warning. Identify fragility. Name where you depend on stable prices, stable rates, stable trade, stable credit. If you can name it, you can reduce it. Build resilience before you need it. Resilience looks boring in calm periods. In unstable periods, it's everything. And now the direct call to action. Subscribe, because the next video is where we go deeper than the headline and map the structure beneath it. How the debt stack, the policy trap, and the trade fracture built this environment, why tariff uncertainty is a symptom, not the disease, and what the next stage looks like if repricing spreads from metals into credit, jobs, and everyday life. Gold and silver already delivered the message. The only question left is whether you're going to interpret it as noise or as the system speaking plainly.